Good morning. Thanks very much for turning up at the unusually early time compared to all the other panels. We've sort of puzzled here why we are starting earlier than the others. But it means we'll all be watching you at 9 when the other panels start to see if anyone gets up and leaves the room. But of course, feel free to leave if you want to see the other panels too. But since we have a small group, we can get an all the more sort of quality participatory discussion, I hope. We have a big panel, so the first half and a bit more of the session, we will take the time to hear the points of view of everyone on the panel and get a discussion going. But I really want to involve everyone in the audience too, since we have such a wonderful audience at BLED. I am Martin Sandbu. I'm the European economics commentator for the FT in London, and I am chairing the panel this morning. And we have a very good panel. Before I introduce the panelists, I'll just say a little bit about the topic. Tax them if you can, and resources, tax resources on the move. I was very excited being asked to chair a panel on this topic because I think it's something that's been left a little bit too much to the technocrats and the experts, and it's actually a sort of deeply important democratic issue and a deeply important issue of international governance and global governance. There's been, let me give you sort of two observations to start with. The observation is that over the last couple of decades, we have seen a shift in taxation in rich countries, largely away from taxing capital towards taxing labor and consumption. And it's reasonable to think that that has to do with the globalization of capital, in particular because there's a lot of evidence that multinational corporations seem to pay an effectively lower tax rate on their profits than domestic corporations. That's the sort of technical tax observation. The political observation is that it's gone a bit in cycles, but it often becomes a political issue, and you will all remember that it became a very big political issue when the crisis hit and pretty much every government turned towards public austerity. The obvious question then was, why are some corporations seemingly paying less and less in tax when governments tell us we need to cut spending and raise taxes on ordinary people? In the last couple of years, there's been quite a lot of movement on the international scale. So the third observation I want to share with you is just what's happened in the G7 setting over the last year. So those of you who follow this will remember that France and some other European countries said, well, we are just going to unilaterally start taxing the turnover of the big digital multinational corporations because the global system for corporate profit taxation isn't fit for purpose. That we will hear from our OECD participant. My reading is that this has sort of turbocharged the process at the OECD for coming up with some international agreement. This has been a sort of flashpoint at each G7 meeting recently, the finance ministers meeting a couple of months ago and the Biarritz leaders meeting just a few weeks ago. So there is a problem, it's an economic and political problem, and something is happening. And so I think it's very timely that we talk about this today, partly so that our panelists can enlighten us and partly so that we can all discuss, maybe disagree, maybe agree on whether we're on the right track to improving things. So that will do in terms of introduction to the subject and the topic. Let me now introduce the panelists, and I have them in alphabetical order here. That's not quite how they sit. I'd like to welcome Marko Mrčnik, who's from Standards & Poor, from Slovenia, but based in Spain, where he's a director for European Sovereign Ratings. We have Sarah Perret, a tax economist at the OECD. And as I said, the OECD is the body that's been tasked with the unenviable job of trying to fix multinational corporate taxation. Frank-Jürgen Richter is the founder and chairman of Horasis, which my impression is that the way to describe it is as a sort of platform where future-looking business leaders can think about sustainable business. and we'll be very interested in hearing what the business take on the tax debate is. Carl Sukup is a director at the Directorate General for Competition at the European Commission. I just insert here that one of the policy tools for dealing with multinational corporate tax issues has actually ended up being state aid and competition policy. I think here about the Commission's case against some of Ireland's tax schemes. And finally, last but not least, Paul Tang, who's a Social Democrat member of the European Parliament, where he's also on the Economic and Monetary Affairs Committee. So we will hear a politician's take on this debate. Wonderful panel. Thank you all for being here. I would like to ask the people who represent multilateral or political institutions to start so we can get the sort of various official angles. And Sarah, if you could start, since as I said, the OECD has a big job here, if you could start by just giving us yours and the OECD's take on what the situation is, what the challenges are, and what is actually being done. Thanks very much.
Yes. So just maybe to start, I can clarify what the OECD is and does because it might not be obvious to everybody. So the OECD has generally two main functions. One is to collect data and comparative statistics, provide policy analysis on a wide range of issues, not just taxation, but education, trade, innovation, any form of policy domain. And the other main task of the OECD is to develop commonly agreed standards and rules. And so the reason why, and in the area of taxation, in the tax department, we have the two functions. But the reason why the OECD has been at the forefront in recent discussions is because, as was just mentioned, that's where the discussions about how to address the tax challenges that arise from digitalization are being discussed. Just to remind you, the OECD has a small membership. It's 36 member countries, but because this issue of tax and digitalization is so global, there are actually more than 130 countries that are trying to come up with a solution. So what is the problem that we're dealing with? I would say the biggest problem is that our current international tax rules are no longer adapted to our current economic environment, where companies can have significant operations in countries without necessarily being physically present there. And just to remind you, now if we want to be able to tax a company, the requirement is that they have what we call in technical terms a permanent establishment, that they're physically in the country. But we know that if you're Netflix, you can have significant operations in a country without having offices, staff, factories. You don't need any of that. And yet, we think that those businesses should probably be taxed. So that's one of the challenges. Another challenge with the digitalization of the economy is that companies' most valuable assets tend to be intangible assets. And those can easily be shifted around, and this is a major determinant for where profits are going to be taxed in the end. So that's where the OECD comes in and tries to find a solution. We can talk a bit about the technical details of what this solution is going to involve. But I just want to mention that's on the digital economy. The OECD has already contributed to major changes in international tax rules on two issues mainly. One is legal corporate tax avoidance. So big multinationals legally shifting their profits to low tax jurisdictions. And that's the big project is called base erosion and profit shifting. And this has already been in place. Countries have agreed to an action plan that contains 15 actions, and so we're in the implementation phase, but that basically means that it's become much, much harder for companies to do what they're used to do of just shifting their profits to tax havens. The other major initiative that the OECD has been working on, and that's already been a major success, is on tax transparency. So we talked about corporate tax avoidance, which is, again, legal. It was companies legally exploiting loopholes and mismatches in tax legislations. But there's also another big issue, which was wealthy individuals basically evading completely taxes by hiding their wealth offshore, and that is mostly illegal. And the OECD addressed that by stepping up tax transparency efforts and pushing for the development and adoption of new tax transparency standards, which basically allow the exchange of information between tax authorities in different countries. So this was to summarize sort of where we are.
Thank you very much. I'd like to turn to Carl and hear the European Commission perspective. I mean, this is the sort of mobility of the tax base is a problem at the EU level as well, of course, but the EU has more tools than the global community has because it is a union. Could you just tell us partly how you just respond to Sarah's introduction and see whether is the Commission view aligned with what we've just heard, and what are the particularly European challenges and efforts at solving the problems?
Thank you. I think a lot of our thinking is aligned with the one which we just heard. For sure, the European Union has been engaged very much in the BEPS, in the base erosion and profit shifting project from the beginning, and I think we were also one of the first jurisdictions to implement the different actions proposed with the Anti-Tax Avoidance Directive 1, Anti-Tax Avoidance Directive 2. But then there was in fact one of these 15 actions, Action 1 on digital economy, which was in fact when the action plan was concluded, was left open, already showing the particular problems there. Together with what we heard in the introduction, that some member states seemed willing some years ago to act alone to fill this gap of how to tax digital companies, we felt that there was not enough momentum in the OECD going forward on this problem, while at the same time there was the risk that some member states would go alone on this in this area, and that's why the Commission proposed last year a solution, a long-term solution, which would take more time, and a short-term solution, which is this famous digital services tax, which was discussed for quite some time in the Council, but failed to reach unanimity in this springtime, which now still leads to a situation where some member states go alone. We know that France has adopted a digital service tax, and which has also led to some, let's say, some problems with the US. But we feel that nevertheless our proposal and the political momentum created also, I think, helped to kickstart again, or to move forward perhaps a bit more quicker the process at the OECD, and which we are now following closely. However, as already said, I'm working in DG Competition, and we have been doing some cases on tax avoidance. So I would like to bring in another element also. When you read the title of the panel, tax them if you can, I think you can interpret it in two ways. The first is how to get a grip on the possibility to tax, and I think a lot of countries find this problematic. That they find problematic that companies are active in the territory, making profits with people living and working there, but they are not taxed there, and they want the possibility to get taxes from these activities. But you can interpret it also in another way, which would then more be a plea: please tax them if you can. So you can, but please also use this possibility to tax them. And this is another side, I think, of the problem, which we see, that we feel that there are jurisdictions which could tax, which have the right also under the current rules to tax, but which do not exercise this right for various reasons. And we have this at the European level, we have it at the global level. And I think that, in fact, this non-taxation or this small taxation, in fact, led to all this public outrage at the beginning, because when you listen, it's not about whether a company pays taxes here or there. It's also an issue, but it's not the main issue. The main issue that there's the feeling, and not only the feeling, that some companies pay nowhere taxes or very little taxes overall. And it cannot be that no country has the right to tax them. Some countries must have the right to tax them, even under the current rules, but apparently they are not exercising them. And within the European Union, we have tried, and I'm happy to talk more about this later, we have tried with the tool of stated control to get a grip on this, and we have been running some cases in the Netherlands, in Ireland, Belgium, and Luxembourg. You know the names of Amazon and Starbucks and Apple, etc. So we've been trying to use law enforcement in parallel with legislative changes in order to tackle this problem. I think we have gone some way, but I think there's also still a long road ahead of us.
Thank you very much. We'll definitely come back to some of those issues, which are fascinating. Paul, you're an elected politician. You represent citizens. Why does this matter?
Well, the good thing about this topic is you don't need to explain it to the larger public. They fully understand immediately. If we pay taxes, why don't they pay taxes? That's very basic. And you saw it when, for example, the European Commission said to Apple, you have to pay back 13 billion. I must say that the Irish government and even the Irish Parliament was hesitant, fighting this decision by the European Commission. But visiting Ireland, I noticed that people said, well, we don't mind this 13 billion, really. So people find it simply unfair. And it's a growing unfairness, right? So that's labor is paying taxes and capital is not paying taxes, that's seen as unfair. And that is the political setting in which we work. And I think that's been a driving force behind the debate. If you look at the G20 in St. Petersburg, where the work of the OECD started, it's basically the G20 leaders point to the unfairness of the tax system. That's a driving force for politicians. We need to address this. One of the disadvantages is that you still need to explain the OECD, right? Because it's not very publicly well known, whereas it should be a public debate. But this is the intergovernmental framework we are still in. So the job for politicians is to address these concerns of unfairness, but we need to have a fundamental change, right? So the corporate tax system is outdated. It comes from the 1920s, when we had factories with chimneys and we didn't have multinationals. So it's completely outdated, and now it's being used by the multinational firms, mainly through intangible assets, right? Intellectual property, digital services, financing arrangements, to avoid taxes, because it assumes, the current tax system assumes still we know what the location is. It's location-based, but what is the location of intellectual property? Is it Ireland or is it Bahamas? You can locate it anywhere, and that's exactly what multinational corporations use. So we need a fundamental change in the tax system. Also, because what it leads now is that countries are fighting each other, because the companies can move profits around. This puts pressure on the countries to fall in line, so to say. So you can say countries could do different, but they feel forced not to. So that's the competitive pressure, so to say. But that some countries are better than others. I have to confess, I'm from the Netherlands. This is one of the countries that is, in fact, a tax haven within the EU. I'm not allowed to say that. Yeah, of course, I'm allowed to say it. But people in my country don't like that I say that. But in fact, there are tax havens within the EU, and it leads to a fight within the EU. For example, Gabriel Zuckman, an economist, put numbers on it, say that the 5 countries, Netherlands, Luxembourg, Ireland, Malta, Cyprus, take away the tax revenue from the larger countries, which have high rates, Germany, France, and bring it towards these countries, these 5 tax havens within the EU. 42 billion euros each year. They keep 5 billion, and the rest goes to the shareholder because it's transferred outside the EU. So we are fighting for tax revenue here, but we don't benefit from it. The shareholders mainly benefit from it. That's the game that's being played. So we have a situation where we are neighbors we are partners within the EU, but we are robbing each other. That's the situation, and that's how it develops. So we need a new multilateral framework for the 21st century, and this is what at stake. And I think competition law has been very prominent, but it's not the fundamental solution to the issues. I'm very happy with the work that the Commission under Margaret Vestager has done. I'm very happy with that. But still, it's just the plugging the holes, just like the first initiative by the OECD, if I might say, was plugging holes where we need a fundamental reform. And now that's this fundamental reform is discussed because you need a new allocation rule. I think we'll come back to that. But this is so the difficult job for a politician is to try to make this non-technocratic, to make a plea for the fundamental reform of the corporate tax system, and in that sense for a new multilateralism. The interesting is that multilateralism, if you witness the first day, is still struggling. Climate change, biodiversity, security. But I still see progress in the area of corporate taxation. So that's where we still see some progress in multilateral cooperation, and that's promising, and that's how we want to work on the next years.
Thank you very much. Your remarks made me think how striking it is that we've had so much debate in the EU about making sure public finances are sustainable, and sometimes very acrimonious and difficult debate, but very little of that has focused on the tax side and what governments may be missing out on. Marco, that leads me to you, because you work kind of on the interface between public finances and financial markets. So just picking up on, we heard one number from Paul, the 42 billion from the Gabriel Zuckman work. Can you give us your view on this issue, and in particular how it affects public finances? How big of an issue is it really? I notice that nobody here has so far kind of challenged the premise that there's a problem. But how big of a problem is it? To what extent do public finances are they actually suffering?
Thank you. Well, clearly, as a rating agency, we're looking very closely at what happens on the revenue side, because fundamentally, that's what's needed to pay down your interest on debt, your obligations, and therefore, it certainly influences the probability of default. So it's one of the key inputs in our indicators. In fact, a number of key fiscal indicators that we take into consideration uses tax revenues as a denominator, interest payments to tax revenues. I can mention one, not to go into more technical details. I think based on literature, one can clearly come to conclusion that for a large country, BEPS, base erosion or profit shifting, implies a loss of corporate income tax revenue of about 20 to 30%, which is not negligible, of course, for a large country. Certainly, it is not very, very significant for them, but I think in times of increasing social pressure because of aging or climate change, as you suggested, I think all these priorities require additional resources. I think this is clearly the case that every little helps. But I think the situation from our viewpoint is much wider as well, because it affects not only tax revenues, I think it affects other macroeconomic variables such as GDP. Let's not forget that in 2015, Irish GDP went up by 26% in real terms, and that's pure illusion, because it was based on booking of IP rights of multinational companies in Ireland. It doesn't have anything to do with the real economy. And then, of course, it has consequences for current account balance, which, as you know, is an indicator of net financing needs of an economy. So taking that on board, research suggests that countries like the UK or France in particular has been usually on the spot for posting current account deficits. If you converted those or prevented that profit shifting, it would end up actually in balance or in slight surplus. And I think one of the most striking cases is Greece. Greece is a well-known current account deficit country. It would change dramatically into a balance or surplus in that case. So these are very, very significant features, which, maybe more than the tax revenues for high tax countries, could move the needle on their ratings. And maybe the countries are not aware of that. I think there are clearly issues with regards to how BEPS is implemented potentially as well. You rightly is saying that this is the case. But what we are perceiving in our conversations, in our analysis, is that what has been happening since BEPS came into force was that the countries or multinationals are actually propping up their operations in those countries to the minimum requirement, not necessarily more than that, because I think there's a very significant difference between tangible capital and intangible capital in order to justify their favorable tax treatment and move on. So basically embed their tax advantages into their business model. I can give you one example from this year. In the first 6 months of this year, Luxembourg managed to get a 45% increase in corporate tax receipts, which is a staggering number. Certainly, part of that is explained by some sort of introduction of electronic reporting. Another part can be certainly related to the economic cycle, but budgetary elasticities just don't work in this kind of multiplying effect. So what we're thinking is that if BEPS went into the other direction, if BEPS were to be prevented, then we would not see such a large increase in the number. I think on a digital taxation, of course, things are very much open. Spain is also considering, but I think the problems are very much political on a daily basis, whether to implement that or not. I think there, clearly, the issue is that of tax base. I think that it's not clear what will be the tax base. Will it be ultimately general turnover of a company or aggregate profits for a fair redistribution? But let's not forget that these practices, such as creating intangibles, are not relevant only for digital industry, but for all other industries. Any company in the world can create intangible. Just consider a logo, charging royalties. So it's a widespread issue. So I suppose, I don't know the details of the underlying negotiations, but I would imagine that some countries would probably push for introduction of other industries into the discussion. So much from me.
Thank you very much. Again, some really good points to pick up on, but we've been talking about these multinational corporations. I think, Jürgen, you've probably talked to more of them than any of us have. What do they think? What do business leaders think here? We don't really hear them come out in favor of reforming the corporate tax system, do we?
Right, they all hide away, of course. But, there's some hope. But let me first say that we all agree here on this panel that the current tax system is kind of outdated. We need a digital tax. We have to reform global taxation with the start maybe with the EU. There are certain tax havens. You mentioned the 5 tax havens before, and I think we have to stop this tax competition. We need maybe a basis tax, at least in Europe, and then thinking about a similar arrangement amongst the G20 countries. But, when you talk about taxes, it's quite interesting. We always try to point fingers. We always say, we're on the right side. Corporate leaders say everything we do is legal. We just, try to interpret the global taxation system. We make the best out of it. It's our duty because we have shareholders, and of course, we have to save the money of shareholders. Countries are always saying, we do the right thing in our own country. The others are the bad ones. Just think about President Trump. We mentioned President Trump, I think, in all sessions. He's like, the big elephant in the room in all discussions here. Of course, he is undermining multilateral thinking, America first. When it comes to taxes, actually, quite interestingly, he is protecting the likes of Amazon, Facebook, and others. Even so, in other circumstances, those companies are his arch enemies, politically, I think, back home in the US. But here, suddenly, he has a fight with President Macron on digital taxation. I think US and France came to a kind of compromise, but we have to see where it goes. But I don't want to talk about President Trump too much. Maybe another US president, President Franklin, who said basically that nothing is certain in life with the exception of death and taxes. And you see, just looking into this quote, everybody thinks that taxes are something bad. We compare it with death and a desperate situation, and the taxman is always knocking on the door. So I believe we have to fundamentally change this mindset, saying that taxes are bad. I think taxes are good. We all should pay taxes for the global public good, and not just try to avoid taxes on the personal income side. We are all paying taxes as individuals, but also on the corporate side, and try to avoid this kind of play of hiding here, using a loophole there, and putting so much energy on hiding taxes. Think about all these tax officers, all these tax accountants, big four companies here. They have to feed 10,000s, 100,000s, millions of tax lawyers all around the world. If you put all this energy in the global public good and say, let's all pay taxes, it's really a shift in our mindset, maybe away from Machiavellian mindset towards altruism. And I think altruism is what we need. So we have to convince corporate leaders that paying taxes is good, and we should avoid this hiding game. And maybe here the politicians should come in, of course, in Brussels, but also on the G20 level. And we have to think about a framework. We have to try out the tax havens. We have to think about the IP issue, moving around it to Netherlands and to Ireland and other places. But then, there are many other places around the world just waiting to attract multinationals. Think about Dubai, think about Singapore, Hong Kong, and other places. Interestingly enough, we don't call those countries tax havens because there are some very important geopolitical implications. US needs Dubai and the UAE, similarly to Hong Kong and Singapore. Hong Kong because China is behind, and I don't want to anger China. So Hong Kong is always a bit of an exception. I know so many people, using the Hong Kong system. Usually they're officially residing there. They're not paying taxes on their global income. They live somewhere else. And, people are very creative and always come up with new solutions. So when politicians do something and try out a loophole or like a tax haven, go for more like a global new system, then creative people come in and have a new idea. So we're always, I think, one step behind. But I would like to call on maybe three measures. One measure, we have to support the OECD. We have to support all kind of multilateral frameworks. We have to start with the European Union. I think we have to be a good example. We have to talk to the 5 countries we mentioned before. We need maybe a basic taxation system, and we have to avoid that certain even European companies move their headquarters around and just go to the lowest taxation. I'm based actually in Switzerland. As you know, it's another tax haven, if you wish. We are not part of the European Union. And there's so many companies moving there, and Switzerland is doing very well, right? And they're all bringing employment. It's not just like, a fake headquarter, but a real headquarter, and Switzerland is doing extremely well. But I think we have to come to a common agreement, at least in Europe. Secondly, we have to call on the corporate leaders to stop this game of hiding taxes and finding loopholes. Maybe here we need a new framework where business leaders can sit together with government leaders and find an agreement where maybe on a voluntarily base, corporate leaders say, okay, we want to support the global public good. We want to be entrepreneurs in the global public interest. And we pay taxes because paying taxes is good. It's not bad. It's something which is a moral duty even, right? And thirdly, I think we should also include all citizens around the world. There's so much of hate between the corporate sector and the private sector. So we have to include all citizens here and say that, we are all living in one world and we all should pay taxes. So that shows just a few points. And finally, I think I'm optimistic. There's some movement. I think the OECD is doing a good job, and Now we have to come to real results.
Thank you very much. Your comments about the attitude to tax, it brings to mind that quote, and I can't at the moment remember who said it, but taxes are the price we pay for civilization. Who was it that said that? Anyway, we've all heard it. It bears repeating. I think this point about kind of the cultural attitude to taxation is really important. But let me just follow up and push you a bit on that. What do the corporate leaders you talk to say when you say the things you've just told us? When you impress that upon them? I mean, can you share with us a single corporate leader who said, "Yes, you're right. I will try and work in this
right.
way"?
Of course, there are a few examples. Take Warren Buffett, for example, but he's not a typical entrepreneur, right? It's not let's say, a typical
he's a financier.
fortune.
He's not
a financier,
CEO,
right?
Yeah.
It's different. So when you talk to corporates, they might go for nice statements globally, and when around in Davos and other places, but then back home, I think they just do the opposite. That's really the point, and I'm always wondering: do we need to kind of force them to pay taxes? Do we need a new instrument? And say, go company by company. Maybe there's like a court, a global court, looking into the issue and said, and I'm not mentioning names of companies here, but to go really company by company and say, is it fair what you're doing? Are you hiding? And pushing them, indeed. I think we need to push them. We can't just hope for the altruistic mindset.
Just continuing with this theme, since we have a politician on the panel, he kind of threw the ball to you at one point. I mean, one thing you do is, of course, legislate, but politicians do much more than that. What do you think about this idea about the attitude to tax has to change, and what's the prospect for doing it? Or is it all about legislation and the rules and the force of law?
Well, let me try not to be cynical. I think it's good that we have in business a discussion on the morality of business, and I think it's broader. You even see it in the US where they, where 150 CEO says no to shareholder capitalism, and I think that's a good change. It's a good start. So I think the morality of business, or some businesses, is welcome. But as a politician, and especially in the matter of taxation, you can't rely on just morality of business, right? So you need to have this framework of rules that indeed forces the companies, whether they like it or not, whether they want it or not, to pay their taxes. So this is where you need to push as a politician. Second, what I try to do, usually with businesses, but also with countries, is to put public and political pressure on them, right? So they don't like it. For example, I've been fighting in my country with Shell, also by filing a complaint to the European Commission, also to put pressure on these companies to make a change. And at the same time, I'm also pushing my own country, saying you're a tax haven. So this is my role as a politician. Yes, I think morality is important, and I use that also to build public pressure, because business leaders and political government leaders are sensitive to the moral pressure, the moral outrage of the public. Like I said, it's unfair in the eyes of public. By the way, I just have to say it's also inefficient, right? So don't forget that, because if we talk about it's not every company that is able to avoid taxes. Usually it's the SMEs are just, and this is the bulk of the economy, let's say 80% of the economy is within SMEs. They usually pay their taxes. So we're talking about a very small number. It's not even the 1% of companies, it's the 0.1% of companies that don't pay their taxes. So this is absolutely inefficient. Like I said, inefficiency is not been driving it, it's more the unfairness that's driving this issue. But still, there's an economic gain. Jan Tinbergen, Nobel Prize winner from the Netherlands, once said, in redistribution is the gain. And that is, for an economist, something to think about. But in this case, it's true. If you redistribute it again and come to a fair distribution, there's an economic gain in there, because it's crucially, it's hopefully inefficient the way we, the way it is now.
I'm glad you made that last point, because it's something I think is often missing. Clearly, there are sort of public finance accounting costs, which you sort of get by just kind of the arithmetic of how much is lost in potential taxation. But the effect on economic growth and productivity, I think we understand much less well, but there's all reason to think it's important, because to rephrase what I think you're saying, it basically distorts competition on the ground. Otherwise, competitive businesses, if they can't move their tax base around because they're national and not multinational, they are outcompeted. Before we sort of go towards the solutions that are on the table, I want to draw a bit more on the expertise of the panel to understand really what it is that has gone wrong. And Carl, you asked, I think, the question when you mentioned the title of the panel, tax simplification. Is it that countries really can't tax? Is the problem one of inability, or is it one of being unwilling to tax? And you said it's a bit of both. I mean, what I'd like is to just hear you reflect a little bit more on that. What's your answer to that question? And if it's, and depending on the answer, why did we get into a position where it's either impossible or governments have been too unwilling? So if you can reflect a little bit more on your own question, then I'd like to see if there's anybody else on the panel who would like to answer that as well. Yeah.
I think it is both. I think it is both. One might be the consequence of the other, because I think the feeling of countries that there's value created, there are profits created in the territory which they are not able to tax is, or at least was, I think at the beginning, very much fueled by the impression that these profits are taxed nowhere, or taxed very little anywhere. I think if from the beginning all these companies would have paid their 15, 20, 25% of taxes somewhere, I think the mood would have been different. But since we know that these companies on average pay much less taxes in relative terms compared to others, in particular to domestic companies, to SMEs, etc., I think that this then fueled also the debate: how could we get a hand on it? How could we tax them? I think we also need to be careful with the notion of tax haven, because it's often equal to a low corporate tax rate, which is not the case. If you take the example of Luxembourg, I think the corporate tax rate there is some 34-point-something%. So it's not that it has zero taxation or it has 12% taxation. It has more than 30% corporate tax rate, only that it's not applied because of all kind of allowed there transactions. You move around IP, interest payments, etc. So I think tax haven does not necessarily mean a low corporate tax base. It's or tax rate. It's more the regulatory framework and how it is applied. I think it was important what was said about the fairness in terms of how you compete on the market between these multinationals and the SMEs who cannot benefit from the kind of tax planning tools the multinationals are benefiting from, because they have to compute their prices in a different way, because they have to pay also taxes before they can distribute profits to their shareholders. So this is impacting their competitive position, and that's also the angle where we were coming from, because our aim as a competition authority is to ensure a level playing field and fair competition. So it is to answer your question from the beginning. I think it is both. I think the main work of the OECD is to answer the first interpretation. So how can member states tax the profits generated in their territory, even if not linked to a physical presence? But even if this is assumed, I think we still have the second issue about how then countries are applying the rules. And I think that's also where, in fact, the work sharing between the OECD or the policymakers and us as competition enforcers are. We are not making the rules. They are done by others, but we are watching how member states are implementing the rules, how they are applying the rules, and this is what the policymakers cannot do, because the OECD is determining the transfer pricing rules, but it is not getting reporting from member states or companies how they are applied, how tax rulings are done in practice, etc., so how they're implemented. And if there's a misapplication on the ground, the OECD has no means to get involved. And this is, I think, the gap which we are trying to fill.
But that's a governance gap, right?
That's national government's gap, yes.
Yeah. Paul, and maybe I heard noises from this side in the Luxembourg examples. Who wants to come in and
I think we
supplement?
commented on tax rate in Luxembourg.
Not just on the tax rate in Luxembourg, but it's not just about tax rates, it's about moving tax bases, right? So that's why it's called base erosion and profit shifting. I also explained to my colleagues, no, we're not done with the minimum tax rate. It will not do, because the game is about moving your tax base to jurisdictions where there are no taxes at all. The Cayman Islands doesn't have taxes,
Just
right?
to be very clear, it's rate versus base. It's
Yes.
not how much you tax, but what you tax.
Yeah,
is the bigger problem.
and see if countries can't or won't. I'm not sure if you look at the history of the. Come with an example of a country that has raised the corporate tax rates in the last 25 years. Let's find. Chile. Okay, she's one. Okay, we have the one exception, Chile. But let's face it, countries don't.
That was before they joined the OECD, wasn't it?
No, I don't think
It
so.
was
But I
just
think
after.
Chile, compared to 2000, I think the only country in the OECD that's raised its corporate tax rate is Chile. That's the only one.
But this just underlines this is the exception to
Yeah.
the rule.
That's
That countries don't raise, but rather lower the corporate tax rate.
Raise to the bottom.
And that has very much related to the fact that the tax base has become mobile, because there's an arbitrage between countries. You rather move your profits, the tax base, from Germany to the Netherlands, because in Germany there's a higher rate than in the Netherlands, and you rather move it from the Netherlands to the Bahamas because there it is zero. So this puts a lot of downward pressure on the tax rates, and just pressure on the countries and also on the politicians. So you need to change the game to get a different result.
I'd like to follow up on this because, of course, again, the title of the panel is a very rich title. It turns out, tax them if you can, catch them if you can. It is this image of something running away when you try to catch it. But the tax base is not a stack of money sitting somewhere physically, right? Tax bases are always legally defined concepts. So maybe Sarah, you can also answer this question. How do we get to the point where it seems like these things run away and we can't catch them, tax them? Given that tax bases are, they're legally defined things, how do we get up in the world in a world where whatever we've defined as the tax base is something that governments can't reach anymore?
I'm not sure I fully understand the question, but I think the whole purpose, you were talking in the introduction about capital being mobile, labor and consumption being immobile tax bases. So obviously it's easier for government to just raise tax on labor and consumption. The whole idea of closing those loopholes under the BEPS project, of increasing tax transparency, is to basically reduce the mobility of, effectively, these tax bases become less mobile because you will have less of an incentive as a wealthy individual to put your assets offshore. That reduces the mobility of capital, and same for the BEPS project. So I think the idea that capital is so mobile and hard to tax in nature, it's true a little bit compared to labor and consumption, but the whole point of these projects, I think, is to reduce the mobility of that tax base, which is capital, and potentially then strengthen the opportunities that countries have to tax capital income, both at the corporate level and at the personal level. Can I also just react to some of the things that were said? I just want to add our figure to the figure that you gave on the amount of revenue that we lose every year from corporate tax avoidance. We did an exercise a few years ago, and we came up with what we consider to be a relatively conservative estimation, so a lower bound estimation, and we came up with a figure of $250 billion US dollars a year. So even a conservative estimation tends to be. Yes, that's worldwide.
OECD countries or?
Worldwide, yeah. But again, this is a conservative estimation, and I think Gabriel Zuckman came up with a much higher number. But just to give you an idea of what kind of money we're talking about, what kind of money we're missing out on. I also want to reemphasize the point that you made, I think, on the fact that this whole talking about digital taxation and the solution that the OECD is trying to find in collaboration with more than 130 countries, it's not just about the big tech firms. It's not just Apple, Amazon, Google, Facebook. I mean, obviously, those are in the target, but the digitalization of the economy and the ability to operate in a country without being present, the importance of intangible assets, that just cuts across all sectors. I mean, there's sectors that are more or less exposed, but whatever solution the solution that we're discussing is a solution that would be applied across sectors, but aimed at addressing digitalization. Again, not just big tech firms. This is not what we're discussing. And then I don't know if we want to get into,
I want you
the
to,
technical.
I was just going to ask you, I want to stay with you. Can you explain what we're now looking at?
Okay. So I don't want to be too technical, but it's still, and you'll see I think it's interesting. But so we're discussing at the moment a solution, and the solution has two components. We call them pillars. And the idea is that ideally we have the two pillars adopted and countries endorse the two pillars and implement the two pillars because they're quite complementary. So the pillar one focuses on what we call the reallocation of taxing rights. And so the idea is what I mentioned earlier. First of all, a company can be made taxable if it has significant operations in a country, even if it's not physically present there. So that's the first change. Under the reallocation of taxing rights, so pillar one, we're still talking about pillar one, the idea would then be to allocate more taxing rights to market jurisdictions, more taxing rights to the countries where companies' customers are located. And that is a major change in the way international corporate tax rules have been designed up until now. It means that a company might be taxable in a country, even if it's not headquartered there, even if it hasn't located its IP assets there or booked its profits there, but just on the basis that it has significant sales in that country. So again, this is a major change, and it gives more taxing rights to where companies actually sell their products and services. Under the second pillar of that digital solution that we're looking at, we're exploring the possibility for what we call a global minimum tax. And so the idea there is that if you have a company that operates abroad and its activities are taxed under a certain level, that still needs to be defined, the country where that company is based would have a right to demand more in tax to recover the difference and basically bring that company's level of tax to that global minimum rate that will be agreed upon. So those are the two. I hope I haven't made this too complicated, but this is what is currently being explored, that solution with the two pillars. Now, obviously, there are political difficulties. We're talking about reallocating taxing rights. We're talking about reallocating taxable profits. And so you will have winners and losers, most likely. The countries that are market jurisdictions, the countries that have big markets, will gain more taxing rights, but that will mean that countries where companies' headquarters are located or where companies' intellectual property assets are located might lose. So this is where the political difficulty is. But there actually, and we mentioned it, there's a bigger risk if we don't do anything. If we don't do anything, we'll have countries going solo, introducing unilateral measures, and we talked about France, we talked about Spain. There are other countries that say, this is not going fast enough. We want to be able to introduce our own digital service taxes. And then what you have is other countries saying, well, if you're going to tax my digital companies, I'm going to retaliate. And this is what we've sort of seen playing out at the G7. So the whole point of this is we need to find an agreement. Otherwise, we're going to have these kinds of aggressive responses between countries. And it's something that we're already seeing in the international trade area. So it's not like it's a crazy scenario.
Thanks a lot. That's really useful. I just want to phrase my understanding of what you said so that we're all on the same page here. So basically, one part is an international agreement about who gets to tax how much of a multinational's profits, depending on where they sell and other things. And the other is to ensure that no matter what the outcome of that is, there'll be some minimum rate of taxation globally for for these companies. Yeah?
That's exactly right. And just on this global minimum tax, just to tell you, it seems like it's a wild proposal, but actually the US already they introduced a major tax reform in 2017, and they basically introduced their own equivalent of a global minimum tax. So it's actually doable. But you summed it up really well.
Both Marco and Paul want to come in. Marco first.
Yeah, maybe just, I think it sounds good. But obviously, we learned something from the international tax regime so far, and that is that we are always discussing possibly US, Germany, France, or the big countries, whereas all these profits are being shifted to low tax countries. I mean, you mentioned pressure. I think that's okay. Public pressure that can help. But in terms of tax enforcement or information availability, I think this may become a problem to implement. I don't know how you read that, but looking at just what has happened, what has been happening in the EU, I mean, it seems that when high tax country wants to grab some of this profit shifted, it goes after another high tax countries because the information is there. The enforcement is easier, there are protocols, and it takes less time. Whereas if they go after Ireland or some other jurisdictions, this seems much more complicated. So I guess there's a bit of an issue on how to implement that. In that context, coordination, of course, is a better choice than pressure, but pressure never really worked. I think that most of us recall 10 years ago when Ireland was negotiating its bailout, and some sovereigns ganged up on Ireland and asked it to change its low tax regime, modify it as a condition for a bailout. It didn't happen, so Ireland didn't sign that. It would change its tax laws. And in fact, a few years later, it introduced new schemes that have been stimulating further low taxes. So I think it's difficult to impose pressure. I think sometimes it might work. I think e-commerce, VAT for Luxembourg, it worked. And it's certainly something that we're looking at. But it takes time, it seems, at least to me, that before it becomes efficient. And let's not forget, I mean, the right to tax is, regardless of how much, low or high, is something that is in domain of sovereignty of any country, and that's what basically differentiates them. And potentially this is what makes it all the more difficult to reach such an agreement.
Sarah, just to be clear, in the proposals discussed now, the rate of taxation above the minimum would still be a national decision.
No, there
what
would
the
be
base
a
would be
global discussion. Yes.
on the rate as well
Yes.
as the base. I see.
Yeah, and
A minimum.
But above the minimum.
Oh, no, above the minimum. No, we're talking about a floor, a minimum. Yes.
So keep an eye on the discussion in the OECD, right? And it partly reflects the discussion we had in the EU and will have in the EU. I've been rapporteur in the European Parliament for two initiatives. One is called the Common Consolidated Corporate Tax Base. Sounds very ugly, but it is in fact the same principle that you allocate taxation rights differently, more based on consumption, on tangible factors. So that's the reform that has been discussed and has been stuck in council. So what is the European position in the OECD discussion, you can ask yourself. The proposal was, let's say, was indeed a reform, but it got stuck in council. And that the reason is that country like Germany is, in essence, very conservative. Berlin is very conservative. And second of all, they are a net exporter. So if you move to a system more based on consumption, they fear they lose out. So you see in the OECD discussion, Europe is split. And this is where we have, I must say that von der Leyen also emphasized this proposal, but also the other one, the DST, the Digital Service Tax, which is an ugly bastard, right? Because it's not a tax on profits, it's a tax on turnover. So you would say it's ugly, but I must say, in view of the feeling of unfairness, the public feeling of unfairness, it it was right to put forward, I still think. And it has its effect, because that was the interesting part. Because the United States was not willing to discuss in 2013-15 to discuss a fundamental reform of corporate tax system. Once Europe came with the proposal of the digital service tax, the Trump administration started to shift, and we had discussions we didn't have with the Obama administration. Because now they became aware, okay, they really want to tax Google and Facebook. Yeah. And, all right, fair, they have a point. And you could say the US replied, yeah, well, then we want to tax BMW or Louis Vuitton or whatever. So that's the discussion changed. So this you see that the unilateral initiative, in this case the European initiative, it failed at the European level. The Council couldn't agree. So there's no clear European position whatsoever. So we're an economic powerhouse. We have a huge interest in this topic, but there's not a clear European position right now. But even a failed proposal like the DST had its effects on the international negotiations within the OECD. And even now, right? So in fact, the proposal by Bruno Le Maire, of course, he is a famed politician. He would like to show his success with the digital service tax. But in fact, he's also pushing the matter. And that's good. And if I myself also introduced in the Dutch parliament with my Dutch colleagues an initiative for a digital service tax, because I truly think that if we have this unilateral approach, it will build pressure for a multilateral approach. But in it shows that we need to have this. We could have or should have European initiative, if only to come to an international solution. And I think they are on the table. They will be pushed again by the next Commission. Von der Leyen already said so in her speech in Strasbourg just before the summer break. But this is the agenda that there is in Europe, and that is on the table. But it's very hard to reach a compromise in the Council.
Just before I turn to this side of the panel and then to the audience, just on the reason why these are turnover taxes, correct me if I'm wrong, but it's because that is compatible with the existing network of double taxation treaties, right, which cover profit taxes. So you can do turnover kind of as a roundabout way of taxing them. Carl, do you want to pick up on that? Why is it that in Europe even in Europe, it's hard to come to a common position on a common corporate tax base or a common approach to digital services tax? What's the hope for a more global agreement if even in Europe we don't manage to agree?
Well, you have to ask member states why it is so difficult. But I think one of the obvious reasons is that taxation is one of the few areas under the European Union rules which is still subject to unanimity. So we have no majority voting, but we have unanimity voting, which means we need each and every of the member states to agree to a proposal in this area, and this irrespective of whether it's under the legal basis for direct taxation or indirect taxation. And this is also why, in fact, the digital service tax at the end failed, because there were some member states at the end who thought that it's still going too far. Others felt it's not going far enough, and you had a majority which somehow could have agreed, but the majority is not sufficient. And even if there are 3 member states against, you cannot adopt this. And the same goes for the CCCTB, this common consolidated corporate tax base, where I think the Commission proposal dates back to 2011. Which means for 8 years now the Council could not find an agreement. The Commission relaunched it, I think, last year on a reduced basis, leaving out the consolidation, so just the CCTB. But still, there is also no progress. And I think the interesting element is, as was already mentioned, that there we had some sort of formula for apportionment which is based on turnover, on labor, and on assets, and I think we find some of these elements now in some of the discussions at the OECD level, because as far as I understand, under pillar 1 you mentioned, there's 3 proposals on the table, where the discussion is a bit halted for the time being. But I think at least for the third of these options, this significant economic presence, it's somehow also taking into account customers it's taking into account employees, etc. So it goes a bit into this direction. And I think that such kind of proposal potentially can be very attractive because it can be attractive to a vast amount of countries around the world. Because we should not only think about European Union and the US, but there's Asia, there's Africa, which I think they are not often mentioned, especially Africa. I think not often mentioned when we talk about international taxation. But when we move to a system where customers are taken more into account, they can also win. So we might also get more momentum on a global level because more countries could sign up to something like this because they find something interesting for them as well. And I think it's also important what Sarah said some time ago. It's not only about digital. It's very much also about traditional. I mean, we are currently running a case, for example, on Nike. So sports shoes, etc. Not because they have so huge digital presence, but there's a lot of IP involved.
The Nike logo is a tax avoidance technique.
The Nike logo, and I think you asked about what half an hour ago. What is the usual setup, or what is the usual transaction which is used? And I think from a European perspective, what we see is that normally you have a multinational somewhere, let's say the US, which says that a lot of its profits comes from a unique intangible, let's say the brand name or marketing, etc., which is all generated in the headquarters in the US. It then gives the right to use this to a company, let's say in Europe or in the Bermudas, but it might also be in Europe, which is then sub-licensing this to another company in Europe. And we had this in Amazon, we have this in Nike. And then you have one company in Europe, which is in fact doing all the business for Europe. Hundreds or thousands of employees, doing all the business, marketing, etc., contracting, etc. You have local affiliates, and these local affiliates are said to do just rubber stamping, simple business. They get a service fee, in fact, for what they're doing. Because it says that all the work is done in this European headquarters. We call this a principal structure. So it says all the real work is done in the principal structure, and all the profits therefore also go there to the headquarters. But then you have above the headquarters, you have this other company in the Bermudas, or even in the same country, which holds the IP and sublicenses the IP. And then suddenly you say, yeah, but in comparison to the other one, this principal company, which until now got all the profits, is the more simple one. Because the other one holds the IP, and the IP has all the value and is the big thing you need. And then all the profits are shifted up to this one. And as I said, either this one is in the Bermudas or Bahamas, or it is in one of the member states, but it is what we call a transparent company. So a company which has is not based on shares, but it's based on one or two physical owners. So that this company, it's called a transparent company because for tax purposes it's not taxed at the level of the corporation, but it's taxed at the level of the owners. But these owners are sitting then normally somewhere in one particular state of the US, for example, or somewhere else, so that you have then a Dutch company, or for example, but it's transparent, so it's not taxed in the Netherlands, and all the profits are moved up. So you have these principal structures, and via the IP, the profits are shifted to an entity which is either not subject to taxation or is subject to taxation in Bermudas or Bahamas, so it's also not subject to taxation. In this way, the profits are moved out of Europe, but in the past they were not moved back to the US, because if they had been repatriated, I think the situation is now changing after the tax reform, but if they had been repatriated, they would have been subject to 35% taxes in the US. So they were never repatriated, and they were somehow collected there and invested from there. So I think this shifting via intellectual property, via license fees, royalties, this is, I think, the major tool we are seeing, and I think on this we need to get a grip if we want to avoid the situation that these multinationals are not paying taxes anywhere.
It's quite a scary sort of picture you paint, actually, of how complicated it is. But it works.
It
right?
works.
Yeah, exactly. Frank-Jürgen.
Well, on your point, Sarah, on the two pillars, I'm a big fan of a minimum global tax. I think that's really what we need. The question is really how to enforce it, and maybe need, and come to the solutions here, we need a new international organization. We got WTO, we got a World Trade Organization, we got several organizations globally looking into finances. We got the IMF, the World Bank, and many similar organizations, but there's no kind of world tax organization as such with authority. And, being there and said, that's what we need, and going for a fair tax system. And that's maybe a solution. And this world tax organization should also include the corporates, Fortune 500 companies, a council. We should involve them, not as like an enemy, but not just be the problem, but also the solution where, decision makers from government and business can work together. So a world tax organization on a very high level with all authorities. It's maybe a dream. I'm not sure if we can get there, but sometimes we have to dream to come up with a fair and just system. On your first pillar, Sarah, I'm less optimistic on taxing companies where they sell their products. And you mentioned, Paul, before German exporting companies, right? SMEs, usually they pay their taxes and they don't have the means of multinationals to shift around things. But just imagine if German SMEs now suddenly would have to kind of pay taxes in the country where they sell, and basically a country like Germany or even Japan and others will totally lose out in collecting taxes. It would really question the whole economic model of a country like Germany, which is built on exports. So you mentioned that there are always winners and losers. I agree, but nobody wants to be the loser.
Because you're not exporting, because that is good in itself. If your export exceeds your imports, you're saving, and you're saving for later. So Germany is aging, so they want to bring back the savings. So now they should have a current account surplus. But if they makes any sense that they have a current account deficit in the future, otherwise they just not know how to live life, so to say. It's not export is not a purpose in itself. Right?
But tell this the German finance minister.
No, I know.
He might have a different opinion.
But Germany is bloody conservative. Berlin is bloody conservative on the day. But I don't think they don't. I'm not even sure they've done the math, because they are the main losers from tax competition. You say 20 to 30% of tax revenue is lost. I'm still challenging Berlin. Do your homework. Do your math. The whole problem with the area of international taxation, we don't have the numbers, let alone a good analysis.
This is presumably where some hope of agreement could be, that if it's possible that the total gains for a reform are big enough that everyone can be shown to more or less or not lose too much. Sarah, you want to come in?
I just want to prevent the confusion. When we're talking about the reallocation of taxing rights, we're actually only talking about the reallocation of a small portion of profits, of taxable profits, which we call residual or excess profits, and it would only be a small portion of that would be reallocated to market jurisdictions, just so that we're clear on what the impact is going to be. And I'm happy to discuss with whoever is interested in the details.
Also
I just
one more
Frank,
point.
you hadn't finished, so let him finish the point, and then we'll get the
we talked a lot about taxing labor and taxing capital, and I fully agree that we have to shift to taxation of capital. But I think there's a third dimension. We should also tax resources, especially natural resources. And those companies, destroying the environment, using advantages, and going to like emerging countries, using the current framework there, destroying the environment. I think here we have to come in. Here, I think politicians should say, stop. Multinationals, they have a duty. Again, I come back to the moral dimension. But we should also tax companies based on resources, not just on capital. I think that's the next step. Just food for thought.
I would really like to bring the audience in, because the discussion picked up so much steam now that I've left much less time for audience participation than I intended. So I'd like to see if there are any questions or comments, reactions to what you've heard. Everyone on the panel has a lot more to say, so it's fine if not, but it would be great if anyone has anything that's been unanswered or unaddressed, or any comments. I'll give you 10 seconds to... I give 10 seconds of uncomfortable silence so that somebody will raise their hand. There we go. Please say who you are.
I'm Dr. Margan, Symbios Energy and Infrastructure Fund, Germany. Sarah, what did you tell us now here? It's a good idea, but I don't believe that we can implementation this first or second pillar, you know. But I think that is a big problem about taxes, you know. Not only we have two taxes, corporation taxes and labor taxes. And corporation taxes, we have really high. If we in European Union something to do about that, we are a little bit looking that not that we must pay 33%. You know what I mean? Suggesting Germany is now that can be 25% next year. We see this, but usually we must look at the country just like Ireland or what did you say before, and Cyprus, you know, and this the big corporation, they want to sell capital, you know, abroad. We must be thinking about charge reverse, you know. We lose a lot of money about charge reverse. I don't know, it's somebody thinking about this, but I think that this panel, that was really good to hear from all you were sitting here, but you must have something doing, you know, compromise. G3 must have something to doing. And I think in Parliament that you can supply your ideas, you know, that about taxes, a little bit compensation or something. This was thinking about the countries, just like in South Europe or Central Europe, East Europe. That's another, condition for life, condition for business, you know, productivity and everything this. And I'm really happy that I heard this. Thank you.
Thank you very much. I did ask from perspectives from the business themselves, and now we got it. Thank you very much. Any other questions before we return to the panel? Yes, please.
Please take a microphone. OECD or EU, do you have some time frames for the action, or just we will continue discussing this?
Good specific question. One more maybe before... No? Let's start with the second one, just to see what the time frame is.
Yes, so on the time frame, the idea is that, the negotiations are ongoing at the moment. We are going to make a proposal public before the G20 finance and central banker meeting in October in Washington, with the hope that we'll then get the approval of the G20, and then the agreement of all the countries that are negotiating in early 2020 to have a final political solution in 2020. The implementation will obviously take longer, but the idea is to have a solution by 2020.
And this would take the form of an international treaty?
It will take, so there are different rules, but in general, yes. That's why the implementation is going to take some time, because some of the provisions will require a multilateral convention, most likely, to update all of the tax treaties. So yes, and just on the point that was made about how it's not going to happen, I think it's true that it is a very serious challenge, but again, we highlight the risks, and I think a lot of countries are aware of the risks if we don't find a solution. And I can give also the example of on the exchange of information and tax transparency. A big change was, for example, that these projects ended bank secrecy in Switzerland, which we also thought would never happen. So I think, you know, there is some grounds to remain optimistic.
I would like some of you to address the worry from business that we just heard, that actually a lot of businesses feel that they're taxed too much as it is, and this sounds like an attempt to tax them more. Frank-Jürgen, maybe you want to address that first.
Well, I think companies always think they're taxed too much, whatever tax level you have. If you go down to even like 5%, I say it's still too much. The question is really, you know, where is, you know, the red line, and maybe that's something to be discussed. You know, where is really the fair line of taxation? Where should it be? How much should companies contribute? And maybe also companies should be able to decide where to pay their taxes. Maybe a bit more like philanthropic mindset, not just kind of giving the money to the taxman, but saying, you know, we would like to support project ABCD. Of course, we all agree that we need infrastructure in a country. We need hospitals, we need schools, the global public good. That's first and foremost what we need. But maybe, you know, it's a very maybe modern approach. Companies can say, oh, I would like to put 30% of my taxes into a certain area. And then I think we have really to change the mindset of saying that, you know, taxes are bad. I started with this argument before. And before you mentioned the shift from shareholder value to stakeholder value. And that's really what we need. We have to include the corporate sector in this global discussion, and we have to forge partnerships between the private and the public sector. Of course, it's very theoretical. How does it work in practice? How can we, I wouldn't say force companies, maybe it's a wrong approach, but how can we inspire companies to do the right thing?
That's a good way to put it. It's also a good way to ask the question to the rest of the panel. How can you inspire companies, or at least reassure them that this is not something that will make it harder to do business?
Oh, we can inspire them by introducing laws. Sorry, no, I don't believe in that. In that sense, that's I like when we have responsible business, no doubt about that. But at the end of the day, this needs to be enshrined in law. You can't rely on the altruism of every company there is out there. Come back to the point of, is it feasible, and does it mean higher taxes for corporates? I think now the tax burden is highly uneven. So it's the largest companies that can use the all possibilities of tax planning, and that is not to companies that are confined to the national borders or are located in 2 or 3 countries. So there's a huge inequality among firms, among corporates. That's the reason why German SMEs still pay taxes, but some of them German multinationals don't. So that's the problem. And it's also feasible because the proposal in the OECD, I don't think, like Sarah said, it's just a part of it, a small part even. But I think it's important because it introduces a new principle, and that's what we need. We need to have a shift in the principle, more going back from the source, intellectual property, going towards destination, the consumer. So that's the major change we are looking at. So it was just introducing the principle. So in the example of Carl, where we have Nike, it's taking the profits out of the EU. That is partly addressed, I think, by the OECD proposal. But the shift inside the EU is still not addressed. So that's still part of, you can still shift your profits, even with the OECD proposal from Germany and France to the Netherlands. So, and that's the first step in the whole scheme. So that's still not addressed. But again, I think the principle is important.
It seems this conversation, I think, illustrates that maybe there is a challenge in communicating what this is going to mean for businesses. Because if I understand you right, what you're saying is if you can fix the Nike problem, that means domestic shoe producers, say, can pay lower taxes as a result, maybe. We're almost out of time, so I want to end on just a very kind of concrete question to all of you. There is, we can all kind of design our ideal schemes and solutions, but there is something very concrete on the table that's being negotiated. I just want all of you to answer very specifically, what do you think is the probability that the current initiative actually ends in success, that there is an agreement next year on reforming the global corporate taxation system along the lines that Sarah and others have explained? So I'm just going to go down the whole panel, and if you can, give me a rough probability that you attribute to the chances of success.
I would say almost zero. Just to be a bit provocative. Next year we will see not much action in the US. We got election in the US, and I don't really think that US will engage with the OECD and other bodies in finding a new tax system. I think for the current administration there are other priorities. Secondly, I believe that we will enter an era of economic downturn, maybe even a new economic crisis, a bit similar to 2008. I'm extremely pessimistic on our economies. Of course, it's all linked to the US-China trade war, Brexit, Germany, as we mentioned before, is already going towards 0% GDP growth. Italy, of course, we know what's happened in a technical recession. And in this climate of economic downturn, it's quite unfortunate. I think there won't be too much hope that we can strike a deal on taxes. So almost 0%.
Almost 0%.
I think I'm more optimistic. I don't think that we will have a full-fledged agreement which really caters for all the issues, but I think there will be an agreement on at least parts of it. And I think what makes me optimistic is that I think it is clear that in the absence of an agreement, we will see more initiatives on a standalone basis. And I think this will give still a big push to decision makers to agree on something.
More or less than 50-50?
42.
42. It's always the...
Very specific.
Cool.
I find it a very difficult question, really, because I'm also sympathetic to Frank. There are an election coming in the US. Congress is defining, not the Trump administration, but at the end of the day, it's the American Congress that defines tax policy. But then again, I'm a politician, so I'm optimistic. So I say 43%.
Yeah, I would say 1/3 probability, or slightly less. I think that everyone hopes that this agreement is passed. Clearly, there are some external issues that in the environment which is not particularly supportive of that. But I think what I'm more skeptical about is actual enforcement of such an agreement. I think that's what, based on the evidence that we've observed, including within the EU, I think there's just not enough grounds to say that we can be optimistic about enforcement in the near term. I would say maybe medium to long term, possibly, but that's what reduces this estimate of probability to below 33%.
So will you bring us above better than even chances?
Yeah, I think I'm not going to give a precise number, but I will say that there's a good chance that there is an agreement that's going to be found. I think, as was mentioned, it might not cover all the issues, so it might not be a perfect agreement, but I think there's a good chance that there's already political agreement on a number of principles, so I think there's a good chance. And again, I agree with the question of implementation, which is a concern. So I think on the agreement, I'm positive that, I'm quite positive that something will come out of it. On the implementation, it's true that it depends quite strongly on countries' own willingness. So, yeah, that's my answer. No number.
But better than 50-50, it sounds like.
Yes.
Thank you so much. We're out of time. I hope you agree with me that we've actually learned quite a bit today. There is a problem, everyone agrees. The problem is big. It needs to be fixed. It's a problem both about what national governments can do and what they're willing to do with the powers they have. And we've learned that there are solutions in the works. There's serious work going on. And on the whole, I think the panel seems to think that the chances of success are not high, but not negligible. So that's quite something. So thank you very much. Please join me in thanking all the panelists for an excellent discussion. Thank you.